It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Well, hello there. Welcome back to another fine episode of Trading Stocks Made Easy. In this episode, we're going to have a little fun because I'm going to talk about what happens when your favorite stock actually pulls back. Well, what does it mean? What is a pullback? What is a dip? And what is a rally? That's what I'm going to talk to you about here in this episode of Trading Stocks Made Easy. So let's get started. Now, you know how I'm always saying to you, your wealth is in your thinking. That means that all the money you will earn in this lifetime is based on what you think is possible and what your financial beliefs are. And then the next thing that you hear me talk about a lot on this podcast is the idea of getting a financial education. So I have changed my life because 20 years ago, I became financially educated about how the financial markets work, and in particular, the stock market. So today, as I share a lot on the podcast, I live in two cities. I spend a portion of my month in New York, a portion of my month in Los Angeles, and I love teaching people how to both trade and invest in the stock market. And I have what's known as financial freedom. Now, many of my students who join me in the Wealthy Investor Program have now begun to experience the same thing. They're earning multiple six figures trading for just a few hours per month. It's not that it's impossible. If you're new to the podcast, one of the things that you should know is that you can have financial freedom, yes, earning $5,000, $10,000, $15,000 a month or more, trading stocks online. It's very possible. Once you get past your limited money beliefs, well, the world is really your oyster. That's the exciting part. Today, we're going to talk just a little bit more about skill. So now you have an online trading account open. You are ready to give it a shot in the stock market. You're ready to follow me in this world of covered call writing, dividends, stock splits, et cetera, But there's another level of skill that you are now going to need to play this game well. The reality is, when we buy a stock, rarely does it head straight up. Why is that? Well, there are these external factors that affect whether a stock price actually rises. Now, I say on the podcast all the time, a stock can only do one of three things: go up, go down, or stay the same. Go up, go down, or stay the same. What are some of the factors that can cause a stock to drop a little bit? Even though it's in a long-term uptrend, what could cause the stock to drop? Well, when a stock drops, we refer to that as either a pullback or a dip. Okay? So let's say I'm going to use a fictitious stock here. I bought one of my favorite stocks at $66 a share, XYZ stock, and all of a sudden I log into my account within 2 days. That stock that I bought at 66 is now at 60, right? It's gone down $6 or 10%. A 10% decline in a stock is what's known as a pullback or a dip. Sometimes stocks run up very, very quickly, and then they'll pull back, largely because the institutions will sell off their shares by using something called a stop-loss order. Now, if you're not familiar with these terms, just sort of kind of hang in there because I'm really teaching you how to play the game skillfully. A stop-loss order allows a trader to quickly sell their shares at a given price. So let's say an institution bought 1 million shares of a stock at $50. It runs up to $66. They can put in an order known as a stop loss, which will cause them to sell out of those shares at, let's say, $60. In other words, if you purchased your shares at $50, it runs up to $66. You can instruct the software inside your trading account to stop your losses at any point. You bought your shares at $50. I could stop out at $62. I can stop out at $60. Why would I use a stop loss order? Because it allows me to lock in the difference between what I purchased the stock for, $50, and $61 or $62 if the stock ever pulls back or dips. Now, what's confusing about a stop-loss order is that it can actually be used to lock in your gains. So if I purchase shares at 50, the stock runs up to 66 and starts to pull back, I can stop out at 62. right? Although I'm using a stop loss order, I'm actually locking in the difference between what I purchased my shares for, 50, and what I'm stopping out at, which is 62. So what causes a stock to pull back? Well, first, the institutional buyers who maybe bought 500,000 or 1 million shares of that particular stock have quickly sold out. Now, they didn't sell out as a loss. They used something, as I mentioned, called a stop loss order. So maybe they bought their shares at, let's say, $55 a share. 6 months later, the stock was at $66 a share. And because they wanted to protect their profits, they're using a mechanism that says, hey, if this stock ever goes below $62, sell off my share. They're stopping their losses. So stop losses happen all the time when institutional investors feel that there's something threatening this particular stock price going higher. So what would cause an institutional trader, for example, to stop out of a stock? Well, one of three things usually occurs. A, something is going on geopolitically, like the tension between the United States and North Korea is escalating. Number two, something could be going on at that company specifically. The company announced that it lost a major client, that it anticipates earning $100 million less than it did a year ago. That would cause an institution to stop out. Or the third and most likely thing that causes an institution to stop out would be something in the sector. So last year, for example, the semiconductor sector was on fire. If you owned semiconductor stocks, you did really, really well. But if one of the major players in the semiconductor sector said they lost a client, it's very possible in sympathy, all of the stocks in the semiconductor sector could drop. Why? Because the institutions would stop out until they were able to interpret the news that came from the larger company. Your favorite stock can actually pull back or dip. What does that mean? That means that the scenarios I just described could cause the stock to drop $5, $10, $6, or $7. So the question for most traders or investors in that scenario is, did they make a bad decision? And I always say no, as long as the fundamentals of the stock stayed the same. Now, what are the fundamentals of a stock? What makes a stock price go higher? In the Wealthy Investor Program, we refer to them as dates. What makes a company a good date? Well, certainly the trend of the stock over the last 5 years, and then how much money that company is actually earning. And we refer to that in the Wealthy Investor Program as fundamentals. So you see, if you're going to be in the stock market, then there's a certain level of skill that you're going to have to acquire so that you can determine when your favorite stock drops $3, $4, or $5, whether that's a bottom or, here's the best part, whether it's a buying opportunity. I'll be right back.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't know which stocks to choose for trading in today's market? No problem. Just follow Tyrone Jackson's hot stock picks inside WITradeschool.com. At WITradeschool.com, you can also follow Tyrone's weekly stock market tutorials and investing advice. Plus, each week you can submit your trading and investing questions directly to our staff, and Tyrone will answer them as part of our weekly video Q&A sessions. Begin your membership right now and you'll get instant access to WITradeschool.com's video library. That means you'll get to know all of Tyrone's major and minor trading strategies, including covered call writing and volatility trading for fast, sexy profits. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. In addition to a successful podcast, Tyrone's editorial content has been featured on CBSMoneyWatch.com, NASDAQ.com, and YahooFinance.com. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
Now, there's one thing that we know in the stock market is that it is the one place where billionaires are made. In fact, within the next 5 years, we're going to see the first trillionaire that comes from the stock market. Why are we getting so many billionaires and trillionaires? Well, now more than ever, technology has given you and I access to Wall Street in a way that we've never had before. But just because we have an online trading account doesn't mean that we have the skills to be successful. And that's what I'm talking about in today's episode by alerting you to the concept of a pullback, a dip, or a rally. Now that we've talked about pullbacks and dips, I want to just make one other distinction here, and I want to talk about stocks that tend to have the most dips. In today's market, the stocks that tend to have the most dips are technology stocks. They tend to be very volatile. Now, what is volatility? That means that these stocks have prices that change very rapidly during the day. A lot of that trading volatility is caused by institutions and then people like you and I who are known as retail investors exploiting those price changes in a stock on a daily basis. What I like to do is use my primary trade to exploit volatility, which is covered call writing. Now, covered call writing means I'm going to buy the shares, not really worry so much about the fluctuation in price. Why? Because I'm buying these shares to generate monthly or nowadays weekly income. So if you're a covered call writer and you're in a stock that's highly volatile, you really don't mind that certain institutions stop out on a regular basis. So when those institutions stop out, they stop out for a very interesting reason. And the reason is so they can buy the stock back cheaper. You see, in today's market, there are certain institutions that stop out on a regular basis. They love to see the price of their favorite stock drop so that they can come back in and buy 1 million shares at a cheaper price. That's what makes a market on a daily basis. Certain people stopping out, other people selling covered calls, and certain people trading on that volatility or news that can come out about a company at any time. Well, if you know that technology stocks are very volatile, what stocks tend to pull back or dip the least? The answer is members of the Dow Jones Industrial Average. Now, what are some of the companies that are part of the Dow Jones Industrial Index? We know there's only 30 of them, and these companies normally have established track records for earnings, meaning fundamentals, as well as trend. You know, companies like Verizon, AT&T, Disney, McDonald's, and Visa, just to name a few. These Dow components, generally speaking, have less volatility because these stocks tend to attract investors. So you see, there's a difference between trading a stock, jumping in and out, and holding it for the long term, and that's called investing. Investors tend to hold stocks without stopping out because they are attracted to the stocks generally because of the stock's long-term performance. So what that means in this market, there's certain stocks that traders like, and there's certain stocks that investors like. So if a Dow stock, for example, were to have a pullback, clearly for people who don't own enough shares of the stock, that pullback would be viewed as a buying opportunity, an opportunity to get into those shares while they're at a cheaper level, but you're going to hold on to them for the long term to build wealth. Traders like volatility because it allows them to exploit what some on Wall Street call the price action. Well, how do you know what is right for you? Should you be trading stocks and investing stocks? Well, that's why most people choose to study the stock market overall. Yes, the stock market can make you a millionaire, but without having a certain level of skill, you just simply won't get there. What I like to teach people how to do in the Wealthy Investor Program is how to focus on stocks that you're holding for the long term and kind of get in on this trading action because it's a lot of fun. And on certain days, until you get used to the wild volatility, it's also a little scary. Now, the reason I'm introducing these tools to you, because I really want you to see that the Wealthy Investor approach is not about smoke and mirrors. It really is about a transparent, disciplined system that you can follow all the time. So if you're a fan of the Trading Stocks Made Easy podcast and you've listened to some of the students who've come on, they've matured. They've learned how to handle pullbacks and dips. They've learned how to hold on to stocks for the long term, and they're following a system that has been proven. Finally, I want to talk to you about another skill that is vitally important. don't just take your money, open an online brokerage account, and start buying stocks that are cheap. Stocks that are cheap, usually stocks that are under $50, are cheap because there's no demand for them in the marketplace. In other words, if you and I are going to be in stocks and we want them to go higher, we want to be in the stocks that the institutions like. It just makes sense. So when stocks are $40, $30, $20, the reason that they are so cheap is because there's very little institutional involvement, and those stocks probably are not going to rise over time. The stocks that you're going to find that are going to rise the most aggressively are anything above $50, particularly in this market. So you see, like any game that you want to play, you have to not only get a financial education, but you have to perfect the skills. Now, although this episode is about pullbacks and dips, and it sounds sort of complicated and there's a lot to learn, I'm here to tell you, you can master it. It's really not that difficult. You just have to know what stocks you're trading, what stocks you're investing, and you must have a sharp and clear understanding of fundamentals. How much is that company earning on a quarterly basis? How much is that company earning on an annual basis? Now, here's one other thing I really want to share with you. Most of my students who are really, really successful in the stock market learn how to live through pullbacks. No matter how great of a trader you are, we're always going to have at least one stock where we lose money. But if we actually make money on 4, 5, or 6 other stocks, then we average our gains against our losses, we're ahead. There was one thing about the stock market I learned early on, which I want to pass on to you. Not every stock you choose is going to be a winner. Now, I know that is a shock. So in a 52-week period of time, if I choose 3 stocks to invest in and 3 stocks to trade, I would expect at least one of those stocks to go against me, to drop significantly, and I'm going to lose money on one of the stocks that I've even decided to trade or invest. Now, I can accept losing money on one stock if 5 of my stocks all move forward without a major pullback or a dip. I am a winner. A lot of times people have these expectations that they're going to do nothing but choose winning stocks. Well, if we're choosing stocks that are outside of the Dow, that are still growing their businesses, one of them somewhere along the line will have a major pullback or a dip. When I'm investing in companies that have a longer track record, I'm less susceptible to a major dip or pullback. So if you don't like losing money, then you want to make sure you have a larger percentage of the money you have in your online trading account in Dow stocks. Why? They're less subject to dips and pullbacks. And finally, I want to talk to you about the best part of being in the stock market, and those are rallies. Now, what is a rally? It's when everything is going right and all of your stocks are rising simultaneously. That's the experience that most traders and investors really enjoy, including me, by the way. There's money to be made in every single direction of the stock market. You just have to learn how to make money when stocks are rising, a rally, when stocks are staying the same, a neutral market, and when stocks pull back in a dip or a drop. With the right financial education, you could be a powerhouse at trading and investing in the stock market. But just like any game, you need to up your skill level in order to be successful. I hope this particular episode of Trading Stocks Made Easy gives you a little bit more insight into what is possible and the realities of being both a trader and an investor in the stock market. But here's one thing I can tell you. If you're really willing to change your life and get a financial education, you can have more wealth, more success than you ever imagined, as long as you keep this trading and investing thing really simple. That's the idea behind Trading Stocks Made Easy. Hey, this is Tyrone Jackson, the Wealthy Investor, saying thank you for joining me for this episode, and I'll see you just around the corner next time. Happy trading.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button, and you'll automatically receive our next episode.